Did you know that if you had invested just $100 in the S&P 500 in 1980, it would be worth nearly $10,000 today? That's right, your money could have multiplied 100 times. Yet most Americans keep their savings in bank accounts earning less than 0.1% interest. Today I'm going to show you how to stop leaving money on the table and start building real wealth. Hey there, Money Talkers! Welcome to Money Talks with Adia. If you've saved up some money and you're wondering how to make it work for you, you're in the right place. Investing might seem overwhelming at first. There's an alphabet soup of terms like ETFs, PE ratios, and ticker symbols. Maybe you've heard people talking about bull markets or bear markets and wondered if they were discussing a zoo. But here's the truth. Investing doesn't have to be complicated. In this video, I'm going to break down why you should be investing your money, how to get started with investing, what to actually invest in as a beginner. And I'll even walk you through a live example of making your first investment. So grab your favorite drink, get comfortable, and let's talk about how to grow your wealth. Let's start with the biggest problem your money faces. It's actually losing value sitting in a typical bank account. Most big banks offer interest rates around 0.01% to 0.15% on savings accounts. Let's put that in perspective. If you had $1 million in a savings account at 0.01%, you'd earn just $100 in a year. That's barely enough for a nice dinner out. But the real issue is inflation. The Federal Reserve targets a 2% annual inflation rate, but in recent years, we've seen inflation rates of 6 to 8%. This means the purchasing power of your money is decreasing by that much each year if it's not growing at a similar rate. Here's a simple example. In 1971, a postage stamp cost 8 cents. Today, it costs 63 cents to mail that same letter. Nothing about the service changed. Inflation just eroded the value of your money. Many beginners also face these challenges when starting to invest. Information overload. There are countless investment options, strategies, and opinions. Fear of losing money. No one wants to lose their hard-earned cash. Analysis paralysis. Not knowing where to start can lead to doing nothing. Market volatility. Seeing your investments go up and down can be stressful. Timing concerns. You might worry about investing right before a market crash. But don't worry, these are all normal concerns, and I'm going to address each one. So what exactly can you invest in? Let's explore the most common options. Stocks. When you buy a stock, you're buying partial ownership in a company. If the company does well financially, your investment typically grows in value. This is one of the most common forms of investment with historically strong returns. Real estate property tends to appreciate over time. Your family might have purchased a home decades ago for $100,000 that's now worth $1 million. That appreciation represents a significant return on investment. Collectibles. Things like trading cards, art, or vintage items can sometimes explode in value. For example, certain Pokemon cards from the 1990s that cost $20 originally now sell for thousands. But for beginners, the stock market offers the most accessible entry point with the most consistent long-term returns. Here's why. Long-term performance. Historically, the S&P 500, which represents the 500 largest U.S. companies, has returned about 8 to 10% annually when measured over long periods. Ease of access. You can start investing with just a few dollars through many modern investing platforms. Diversification. You can easily spread your risk across many companies. The key is understanding the difference between individual stocks and index funds. Individual stocks, buying shares of specific companies like Apple, Tesla, or Coca-Cola. This approach requires more research and typically carries more risk. Index funds. These are collections of stocks that automatically track entire market indexes. For example, an S&P 500 index fund contains small portions of all 500 companies in that index, from Apple and Microsoft at the top to smaller companies you might never have heard of. For beginners, index funds offer significant advantages. Instant diversification across hundreds of companies, lower fees than actively managed funds, historically reliable returns, much less research and monitoring required. One look at the S&P 500's performance since the early 1980s shows a clear upward trend, despite occasional downturns like the dot-com bubble burst in 2000 or the financial crisis in 2008. While there are periods where you might lose money in the short term, over longer horizons, 10+ years, the market has consistently trended upward. Now for the most powerful concept in investing: compound interest, what Einstein allegedly called the eighth wonder of the world. Here's how it works. When you invest $1,000 and earn 10% in a year, you end up with $1,100. The next year, you earn 10% not just on your original $1,000, but also on the $100 you earned, giving you $1,210. This continues year after year, creating an exponential growth curve. Let me show you the magic of compounding with a simple calculation. If you invest $1,000 with a 10% annual return, after 1 year, $1,100, after 2 years, $1,210, after 10 years, $2,594, after 20 years, $6,727, after 30 years, $17,449, after 40 years, $45,259, your money multiplies 45 times without you adding a single dollar. Now imagine if you consistently added $100 each month to that investment. After 40 years at the same 10% return, you'd have over $600,000, despite only contributing $49,000 of your own money. The remaining $551,000 comes purely from compound growth. This is why starting early is so crucial. Even small amounts invested regularly can grow into life-changing sums through the power of compound interest. Before you start investing, make sure you've covered these basics. 1. Pay off high-interest debt, anything over 10%. 2. Build an emergency fund covering 3 to 6 months of expenses. 3. Only invest money you won't need in the short term. As for where to invest, you have 2 main account types. Retirement accounts like 401(k)s, IRAs, or Roth IRAs, or their equivalents in other countries, offer tax advantages but usually restrict access until retirement age. Brokerage accounts are more flexible but don't offer special tax benefits. For most beginners, I recommend starting with 1. Your employer's 401(k) if they offer a match, that's free money. 2. A Roth IRA for tax-free growth. 3. A regular brokerage account for additional investments. Let's recap what we've learned. 1. Your money loses value sitting in low-interest savings accounts due to inflation. 2. Investing in the stock market has historically provided 8 to 10% annual returns over the long term. 3. Index funds offer beginners an easy way to diversify across hundreds of companies. 4. The power of compound interest can turn small, consistent investments into significant wealth. 5. Start by covering your financial basics. Then consider tax-advantaged retirement accounts and regular brokerage accounts. Remember that investing is a marathon, not a sprint. Don't worry about timing the market perfectly or picking the next hot stock. Instead, focus on consistently investing in broad market index funds over time. The best time to start investing was 20 years ago. The second best time is today. If you found this video helpful, hit that like button and subscribe for more financial wisdom. Drop a comment with your biggest investing question, and I'll address it in a future video. Next week, I'll be showing you how to build a complete investment portfolio step by step, so make sure you're subscribed so you don't miss it. This is Adia from Money Talks, helping you build wealth $1 at a time. Before we wrap up, I want to give a huge shout out to some of our amazing viewers who have shared their success stories with us. First up, we have Sarah from New York. She started investing just 6 months ago following our beginner's guide, and she's already seen a 15% growth in her portfolio. Way to go, Sarah! Next, there's John from California. John was skeptical at first, but he took the plunge and diversified his investments. Now he's on track to retire 5 years earlier than planned. Incredible work, John! Lastly, a big shout out to Emma in Texas. She used our tips to start a college fund for her kids and is well ahead of her savings goals. That's what it's all about, Emma. If you have a success story to share, drop it in the comments or send me a message. Your story could inspire someone else to take that first step towards financial freedom. Remember, every investment journey starts with a single step. Keep learning, keep investing, and keep growing. Until next time, this is Adia from Money Talks.